A staggering $41 trillion has quietly shifted within the shadows of the global economy, fundamentally changing how businesses operate. To understand the scale, look at this chart comparing that figure to global GDPs. $41 trillion is larger than the total economic output of most modern nations combined. For decades, if a mid-sized or large company needed a serious infusion of cash to grow, the route was fixed: a Wall Street bank. You would sit across from a loan officer and hope for an approval. Traditional, highly regulated banks functioned as the primary gatekeepers of corporate capital. They dictated the terms of expansion for almost every industry. That system broke in 2008. The financial crisis exposed the systemic risks of traditional bank lending, and as employees walked out of Lehman Brothers, the risk became impossible to ignore. The response was a wave of new regulation. Lawmakers signed sweeping oversight into effect, drastically increasing the capital banks had to hold in reserve. Banks responded by pulling back. The compliance costs were high, and the new risk thresholds were tight. For many corporate borrowers, the bank vaults simply locked shut. This created a bottleneck. While the global economy was recovering and companies needed money to grow, the traditional lenders were paralyzed, leaving a multi-trillion-dollar vacuum. A new solution stepped into that vacuum: private credit. These are non-bank institutions, like specialized funds and private equity firms, that lend directly to companies. These new lenders operated without the massive bureaucratic layers of traditional banking. They could evaluate a business and approve a loan in a fraction of the time. This side-by-side comparison shows the structural difference. On the left, the bank path is slowed by regulatory checkpoints. On the right, the private lender offers a direct connection. Borrowers realized they could cut banks out entirely, negotiating terms that fit specific cash flow needs. This move established a high-speed financial infrastructure. For thousands of companies, this direct bypass became the preferred way to access capital. But if these firms aren't banks, where did they get $41 trillion? The money comes from institutional investors, massive pools of capital, like pension funds, large insurance companies, and university endowments. For years, interest rates were at record lows. These institutions were desperate for higher returns to meet their future obligations to retirees and students. Safe government bonds weren't enough. This visualization shows the result of that hunt for yield. Huge volumes of institutional capital flowed directly into private credit funds, driving the market up to the $41 trillion mark. It was a self-sustaining engine. Borrowers who couldn't get bank loans met massive investors hungry for the interest those borrowers were willing to pay. Private credit has shed its reputation as a niche alternative. It now claims a massive portion of the corporate lending landscape. Wall Street's biggest names are now scrambling to adapt. They are either launching their own private credit arms to compete or losing market share to those who did. The center of gravity for corporate debt has migrated. The core function of providing capital has moved from the regulated public sector to the private sector. But there is a trade-off. While this system is efficient, it operates almost entirely in the dark, without the transparency required of public banks. Because these loans are private, regulators have very little visibility. It is difficult to know exactly how much debt these companies are carrying or how risky those loans actually are. This leads to an urgent question. What happens to this massive, interconnected web of pension money when the global economy faces its next recession and companies begin to default? The next financial stress test won't rely on traditional banking safety nets. It will depend on the untested strength of a $41 trillion shadow ecosystem.